Hey, my name is Sean, and I'm going to be talking about sensitivity analysis as it pertains to financial management and capital budgeting. We're going to start by identifying the goal and functions of financial management, then go further into qualitative and quantitative steps involved in sensitivity analysis. Last, we're going to cover how internal and external financial methods are used to assess and manage project risk and capital budgeting decisions. Now that everyone's super pumped, let's get started. The primary goal of financial management is to maximize the value of a company for the shareholder. This is through making financial decisions that balance profit margin, risk, and cash flow. By focusing on long-term management, we can ensure sustainable growth while protecting the shareholder's value through financial stability. Some short-term investments or divestments can help, but the long term will always be our focus. The first question we have to ask ourselves before making a financial decision is, how does this decision impact the wealth of the shareholders? Our financial management consists of three core functions: investment decisions, budgeting, and determining capital structure. Investment decisions include what and when we should pursue different projects. Our budgeting decides how those investments are funded, whether it be debt or equity. Our capital structure determines how our profits are handled, whether we redistribute to shareholders or reinvest back in the company for expansion. Sensitivity analysis is nothing more than looking at our company and making adjustments to the single variable to see how it will impact our future health. It helps us take an educated guess on how our decision making will impact future operations. Qualitative steps of the analysis involve judgment and interpretation rather than calculation. We can assess uncertainty, including demand or market changes, which are external factors. We can evaluate how, if our decisions are going to align with our company goals. The quantitative analysis is about crunching the numbers. First, we have to find a baseline for our company operations, then identify output variables we will be adjusting for the analysis, then recalculate the output from what we originally had. The output is what helps us measure whether or not making the adjustment is in our best interest. It can also tell us whether or not the project is worth taking the risk. Managing risk requires understanding how uncertainty affects investment decisions. Sensitivity analysis helps our managers anticipate potential downside scenarios and evaluate the benefits of a project. By identifying high-risk variables, our organization can adjust, redesign, or choose alternative investments within our acceptable risk profiles. The example we have up here on the slide is looking to adjust a variable within our WACC. So first we have to find our WACC, and let's say the project is an average risk project. We would take our actual company WACC and use that as the variable. If it's an above average risk, we would change our WACC to reflect that. Below, same thing, and changing those inputs will change the output when we do the sensitivity analysis to see if it's actually acceptable risk. When we talk about internal and external financial methods, we are talking about what we can and can't control. We can control our capital structure, the goals of our company. When we adjust variables for sensitivity analysis, we will get the most reliable information from moving internal variables. Most of the external factors are market-driven and include economic conditions, competitor behavior, interest rates, and industry trends. We integrate all these methods for evaluation so we can make a more strategic and value-driven decision. So how do we bring this all together? Effective financial management in all its facets supports our company by allowing us to make informed capital budgeting decisions by combining qualitative judgment and quantitative analysis. Sensitivity analysis plays a critical role by exposing risk and uncertainty. When internal and external financial methods are evaluated, we can make a more strategic, value-driven investment decisions.